Infinite Banking 101. What is it? It's a commonly used phrase to reference the practice of storing money inside of a strategically designed whole life insurance policy with a major mutual company that pays tax-free interest in dividends to the cash value stored inside of the policy. There is only one place in the entire IRS tax code that allows you to pay no taxes on interest-bearing account, and that is the IRS Tax Code Section 7702. Some of the immediate benefits of infinite banking are compound interest growth, tax-free growth. It's liquid, accessible. It's protected by the death benefit. It's protected from litigation, currency standard protection, retirement income, generational wealth. It's a tier 1 asset that can be used as collateral. There are living benefits, which include early disbursement of death benefits for chronic illness, specified medical, and terminal illness in the policies. There are 5 parties to the contract: the owner, insured, beneficiary, carrier, and the agent. The owner is the person who pays for the policy. They're the person who owns the policy. And that may be different than the insured. The insured is the human being that is being insured. So for example, I may be the owner and my wife is the insured. So she's insured, but I own the policy and I'm making payment for it. And there's an insurable interest because she's my wife, right? Another scenario could be the owner could be the trust. So I can have a trust, or my business could be the owner and I'm the insured. So that's 2 different ways there. The beneficiary is going to be who gets the death benefit, who gets the reward at the end, right? So the owner is one person, and that could be a human being, that could be a trust, that could be a business. The insured is one single person, one individual. And then the beneficiary could be more than one individual. It could also be a trust, it could be a nonprofit, and it could be split up to different people. And of course, the insurance carrier themselves, the company that is providing the policy, and then the insurance agent that helps the owner and the insured to implement the policy. So these are the 5 parties to the insurance contract. Some of the common terms that you need to be aware of is number 1, life insurance contract. Now, this is an important term because inside of a life insurance contract, your cash value that grows is protected from any taxation. So it's tax-free growth inside of a life insurance contract. But there's something called a modified endowment contract, or a MEC, which is when an insurance policy, a life insurance policy, is overfunded. There are limitations to how much cash value you could put into the policy. If you overfund the policy, it will then MEC. It becomes a modified endowment contract, and that now becomes a taxable event. So you don't ever want to do that. You'd have to be pretty hard-headed or stubborn to MEC your policy because number 1, at least if you're working with me, you're going to know the limitations of what the policy can do, so you don't MEC your policy. And number 2, your insurance carrier is probably going to warn you before you MEC the policy if in fact you do MEC the policy. Now, if you're working with an agent and they don't know what a MEC is, and they're showing you an insurance policy and they can't tell you whether or not that policy is going to MEC or when it's going to MEC, then you need to maybe look at working with another agent, because this is going to be the difference between you growing your cash value tax-free or having to pay taxes on that cash value. The face value, which is the next item, is the death benefit. So when you hear the word face value, when someone says, what's the face value of your policy, what they're asking is, how much death benefit does your policy have? Okay? Your cash value is different than your face value. Your cash value is the amount of cash in the policy that grows compound interest, and that cash can be surrendered or it could be borrowed against. Your base premium is the minimum insurance cost to purchase the policy, which includes the death benefit and any insurance fees, but it's the hard cost of the insurance policy. Your paid up additions, or PUA, is basically the saving space or the vault inside the policy where you can store cash and grow it, compound interest, tax-free growth. Now, if you surrender cash from your policy, then you're basically withdrawing the cash. You're taking it out of the policy. When you do that, that is now taxable. So you never want to withdraw. You want to always take a policy loan and borrow against the cash value. So when you borrow against the cash value, the money stays inside the policy, continues to grow, compounding interest if the insurance carrier is a non-direct recognition insurance carrier. I'm skipping ahead. So now the policy does have interest. So there's policy loan interest. And so you also want to make sure you pay the interest on the policy so it does not compound against you. And now you have a direct recognition versus a non-direct recognition insurance carrier. A direct recognition insurance carrier means that when you borrow against the cash value, they stop paying the dividends on that portion that was borrowed against. A non-direct recognition continues to pay the dividends on that cash value, even though you've borrowed against it. So in my preference, I recommend personally a non-direct recognition insurance carrier so that when you borrow against the policy, it continues to grow inside the policy. A rider is basically an add-on to the policy. So there are many different types of riders. You can have a child rider, a term rider. You can have an early death rider. There's so many different types of riders depending on the insurance policy. But what a rider can do is add on features to the insurance policy at a very low cost in most cases to strengthen or add more value to the policy. And then split. So we're going to go ahead and talk about split in the next section. And basically the split is how much is being allocated towards the base and how much is being allocated towards the cash value. So if you're designing an insurance policy for infinite banking for that purpose, then the most aggressive split is going to be 1090, which is at the bottom, 1090, right? Which means 10% of your money, of your premium, goes towards the base cost, the base premium, and 90% goes towards cash value, okay? And this is going to give you most of your money, growing compound interest and cash value that you can borrow against. Now, the minimum for infinite banking would be a 50-50 split, and that's really cutting it short, guys. When you look at other policies that are doing a 60-40 split or a 70-30 split, that's no longer an insurance policy that's designed for the purpose of infinite banking. So ideally, you really probably want to stay somewhere between 1090, 2080, 3070. In that range is going to be a really good policy. But depending on your goals, if you do not have any short-term needs for accessing or borrowing against the cash value, and you're thinking about creating the policy more for a long-term retirement planning, then a 40-60 or 50-50 split will be very strong for that purpose because you'll have more money allocated towards the cost of insurance, which will pay for more death benefit, which will allow the money to grow stronger in the long run. In the end, it's going to be very close after 10, 15, 20 years of maintaining a policy. The numbers are very close. But you can measure that and compare that, and you should do that before you say yes to a policy design. So just to reemphasize, when we're talking about splits, the split is how much of your money is going towards the base premium, how much is going towards cash value. And just think of it like this. Your base premium is the hard cost. That's your commitment to the insurance carrier. So no matter what, you're going to make that payment to the insurance carrier. That's the cost of the insurance. Your cash value is flexible. That's a commitment to yourself. If you don't pay that, you're not going to be penalized. In most cases, it just depends on the insurance carrier. But with the insurance carrier that I'm typically and mostly working with my clients, there's no penalty if you don't pay into the cash value. But obviously, if you looked at an illustration and you expected to put 10,000 or 50,000 or 100,000 in cash value year after year, but you don't actually do that, then obviously the illustration is not going to perform, or the real policy is not going to perform as the original illustration. Not because the insurance carrier didn't deliver, but because you didn't fund the policy as planned. And so your cash value is flexible. There's no penalty if you don't pay into the cash value, but that's your saving space. So that's a commitment to yourself in terms of how much money you want to save in the policy. Now, I have to talk about index universal life insurance and when we get to this part here, and that's because there's a lot of insurance agents that are out there that are trying to sell index universal life insurance as the policy design or the type of policy for infinite banking. Index universal life, or IULs, are not designed or are not ideal or optimal for infinite banking. They take time for the cash value to grow, and it's really a much higher risk product. It is not a savings product. It's an investment product. So if you understand the risk and you're willing to take that risk with an IUL, then go ahead and purchase one. But if you're looking for a safe place to park your money, then you don't want to put it in an IUL, because an IUL is not a safe place to park your money. It is an alternate investment strategy that the insurance companies have created, and they transfer the risk from themselves to you in an IUL policy. It takes time for it to grow. So I've heard people tell me, well, if I set up this policy, how soon can I borrow from it? I was told that I have to wait 2 to 5 years, or even 5 to 15 years. And that's because they're showing you an IUL. When we do a whole life policy, depending on how much you fund that policy in the beginning, you can access that cash value immediately. And when I say immediately, I literally mean within 30 days. So you don't have to wait a year or 2 years to access your cash value with a policy loan. The right design is a whole life policy with a major mutual company. Anything else is not infinite banking. All right, so these are some basic rules to follow if you are going to practice infinite banking. Number 1, you always pay your base premium on time. Number 2, don't forget to fund your savings vault. Add money to your savings anytime and as much as possible. So just like you're going to put money in your checking or savings account, you want to put money into your infinite banking and your whole life insurance cash value into the paid up addiction section, and put that money into the savings vault as much as you can, as often as possible. Number 3, do not overfund or mech your policy. If you find that you want to put more money or more funds into the policy than allotted per year, that's a great problem to have, and we can simply open up another policy. Number 4, when borrowing from your policy, I recommend not borrowing more than 80% of the available cash value. But even more conservatively would be 60% is best. So you can borrow the maximum amount allowed if you want to. 60 to 80% is just what I recommend. The maximum allowed is 90% of the cash value. Number 5, on any borrowed cash value, be sure to always pay at least the interest, as it will compound against you. Number 6, the sooner you can pay the principal on the borrowed cash value is the sooner that you can borrow from it again, just like a line of credit. So again, treat your policy like a bank. You're the bank and you control the payback schedule. But if you pay it back sooner, then you can borrow again from it. You can borrow from it again and again and again, just like a line of credit. Number 7, any changes that need to be made from payment to beneficiaries, etc., you will contact the insurance carrier directly to make those changes. Number 8, Though you are not required to pay back your policy loan on any specific schedule, and though the death benefit will cover the balance on any open policy loans, there may be a tax consequence in that event. So it is a good idea to pay back the loan balance while you're still living to avoid taxes. And number 9, remember, life insurance is not an investment. It is not an investment. It is an alternative, safe place to park your money. While it grows tax-free, compound interest with access to the cash value via a policy loan so that you can invest in whatever you want. At the end of your life, you have a death benefit, which is generational wealth and legacy. If you'd like to see a personalized custom policy illustration with no obligation, you can submit for a request in the description below. You'll see a link to do that.